All right, even with today's relatively tame inflation report, there has been a recent surge in oil and other energy prices that is raising concern that the Fed might not be finished with its rate hike cycle. Jim Bianco joining us right now for more on that. He's the president and macro strategist over at Bianco Research. Jim, we love Chicago so much. We just talked with Diane Swank, and we decided to come back to you despite everything Katie tells us about how great New Jersey is. I do want to get a sense out of you here about this sort of reacceleration fear in inflation and how much we can read into the recent uptick in certain energy prices, particularly in the oil space, as to whether that might be a cue as to what could happen next.
There is some fear of a reacceleration. It's all around the base effect. In July of last year, the inflation report was 0. We just printed 0.2. So the inflation rate went from a year-over-year 3 to 3.2. In August of last year, it was 0.2. And then that gets to your point. Gasoline prices are up 6% over last month. Now it's only the 10th of the month. But it looks like that's going to hold because crude oil prices in the last 6 weeks are up 25%. And if we were to see that kind of gain hold, you're talking about an extra 0.2 to 0.3 on the inflation report for August. And that might be one of the reasons why the Cleveland Fed's nowcast has the inflation report printing as high as 0.8 for the month of August. And if that happens, we're back into the high threes and like 3.6, 3.7 year-over-year inflation. And my contention has been, if we see that, this Fed is not done. There will be another rate hike this year. And if we continue to see inflation kind of hover near that 4% level, we might even see more rate hikes in 2024 instead of what this consensus is calling for, rate cuts.
That's right. I mean, the market really is betting on that. Does that bring up, though, the possibility? I mean, everyone's been talking about this soft landing, particularly after seeing today's report that maybe Jay Powell is finally going to pull off this, what most people thought was going to be the improbable here. But does this mean necessarily that the flip side of that has to be a recession?
It doesn't have to be a recession, but a recession would help with the inflation because it would sap demand and it would bring down inflation. But if we continue to see growth, and I'm in, let me call it, from Torsten Slok, the no landing camp. The plane just keeps flying. There is no slowdown. And that will continue to also bolster pressure on the economy because people will be staying employed. People will demand things. They will have wealth from the stock market gains. And you could see that also translate into higher inflation as well. So, yes, if you had a recession, that would be one way to accomplish getting rid of inflation. I like to joke that's like saying that my wife says we have termites in the house, so I get a blowtorch. Well, you wanted me to get rid of the termites, and that's a way to get rid of them, but that's not the preferred way.
There's a lot of metaphors there, and I like them all. Let's talk about the no landing a little bit more. And I'm still trying to work out what that looks like. I think planes do have to land at some point. But what does the no landing playbook look like if you take this to the markets?
So it looks like 2%, 2.5% growth on benchmark just continues quarter after quarter. By the way, if you want to argue about a recession, I'm still in that minority camp that it happened last year with the 2 negative quarters and the 20% decline in the stock market, and that it's not ahead of us. It's actually a year ago that the plane landed, if we want to stick with that metaphor. But if you continue with the 2.5% growth, the good news is you should get an earnings rebound, and the good news is employment will stay. But it might come with a consequence of sticky inflation and higher interest rates. So that's the balancing act that markets are going to have to figure out if we continue to see that 2.5 no landing scenario from moving forward.
Is that priced in, that no landing scenario, or which asset classes would have to recalibrate to that reality?
I don't think it's priced in. I think what you've seen in terms of the concentration in the stock market, it's been one of the most concentrated rallies we've ever seen. The Magnificent Seven, the big mega cap tech stocks have been 2/3 to 3/4 of the rally. If you look at micro cap stocks, which are probably closest to being the most economically sensitive, they were still down on the year as late as early July. And so they've only started to pick up. So if that no landing scenario comes, These companies have earnings. These companies have growth. They could continue to rally. That might not do anything for NVIDIA or might not do anything for Microsoft, but it would definitely help those very small microcaps companies. And so, no, I don't think it has been priced in to that degree.
I am curious then, Jim, about some of the action that we've seen in the bond market. We were just talking with Ira Jersey about that 30-year auction and the lack of uptake, if you will, on that here. And what does that signal about investor sentiment and the Fed?
So I've always said that auctions have a shelf life or a half-life of about 24 hours. That after about 24 hours, whatever narrative we put on them is gone. Yesterday's 10-year note auction was perceived to be very good. And then that meant a lot of things that people said about the nature of the bond market, which couldn't even make it to today because the 30-year auction wasn't as good. And so now the yields are moving up in response to the 30-year auction, but by tomorrow afternoon, it should be over. Auctions don't typically give us, I believe, a long-term look into where the bond market's going. They're always very short-term.
All right, Jim, I'm going to have to leave it there. Always great to catch up with you. Jim Bianco over at Bianco Research as we keep an eye on the